Picture two neighbors on the same street, same city, same year, same amount of money to invest. One of them puts it in the stock market and watches it grow. The other one waits, watching from the sidelines, because he thinks the market looks too high, too risky, too much like a bubble about to pop. 10 years later, one of them is on vacation. The other one is still waiting for the right moment. Here's the thing nobody tells you about bubbles. They are almost impossible to spot while you are inside one. And the price of being wrong is enormous. Today we are going to talk about something that makes every investor nervous. Is this stock market a healthy bull run? Or is it a bubble about to burst? And most importantly, what should you actually do about it? Let's start with a number that will make your eyes go wide. Right now, the stock market is trading at 41 times its long-term earnings average. The historical average is about 17 times, so we are more than double the normal level. That sounds terrifying, right? Before you panic, let's talk about what that number actually means. Think of it like the price tag on a house. If a house normally sells for $200,000, and this one is listed at $400,000, is it overpriced? Maybe. But what if this house has a brand new kitchen, a pool, and a view of the ocean? Then maybe it's worth it. The stock market's price tag is high right now. But the question is, what are you getting for that price? And to answer that, we need to go back in time. 3 times in the last 100 years, the stock market got so expensive it blew up. The first time was 1929. The market crashed nearly 90%. It took 25 years to recover. 25 years! If you were 40 years old when it crashed, you were 65 before you were whole again. The second time was the year 2000. You remember the dot-com boom? Everyone was throwing money at internet companies. Companies with zero profit, zero customers, sometimes zero product, just a website and a dream. The market fell nearly 50%. Tech stocks fell 77%. It took 12 years to fully recover in real terms. The third time was 2008. The housing market collapsed. Banks nearly went under. The market dropped almost 57%. Took about 5 years to come back. 3 crashes. 3 different causes. But one thing in common. Before every single one of them, people thought the same thing. This time, it's different. So let's ask the honest question. Is this time different? Here's where it gets interesting. Meet Marcus. He is a 34-year-old teacher from Ohio. He has been putting money into index funds, a basket of stocks, every month for 3 years. Index funds just means you own a tiny piece of hundreds of companies at once. Marcus does not pick stocks. He just buys the whole market. Every paycheck, a little goes in automatically. His coworkers think he is boring. You're just buying everything, they say. Marcus shrugs. He keeps buying. Now meet Jake. Same age, same city, same starting point. Jake reads the news. He sees the market hitting record highs. He sees analysts saying, bubble, bubble, bubble. He decides to wait. I'll get in when it corrects, he says. That was 3 years ago. Here is what happened since then. The market went up over 40% without a major crash. Marcus kept buying through all of it. Jake kept waiting for the dip that never came. Jake's money sat in a savings account, earning almost nothing. And here is the painful part. Jake was not stupid. He was actually being careful. He read the same research you might be reading right now. He just drew the wrong conclusion from it. So what does the research actually say? Here is something that surprises most people. The market has looked too expensive for years at a time and kept going up. Back in 1996, a famous economist said the market was irrationally high. That was 4 years before the dot-com crash. Investors who got out in 1996 missed 4 more years of huge gains. The same thing happened in 2017. By every measure, the market looked overpriced. It kept rising for 4 more years. And right now, since October 2022, the market has already gone up over 110%. People who sat out because it looked too high missed all of that. The market does not crash just because it looks expensive. It crashes when something breaks. In 1929, it was reckless borrowing that broke. In 2000, it was fake companies with no real business that broke. In 2008, it was millions of bad home loans that broke. So what could break today? Here is what the biggest banks on Wall Street are saying. Goldman Sachs says the market is not a bubble. They think company profits will keep growing this year. JP Morgan agrees, but says you have to be picky about what you own. Vanguard is the most cautious. They think the market will grow slowly, maybe only 4% to 5% a year over the next decade. Not a crash, just slow. Now here is where it gets really interesting. For the last 3 years, almost all of the market's gains came from just 7 companies. Apple, Microsoft, Amazon, Nvidia, Meta, Alphabet, Tesla. The Magnificent Seven, they call them. In 2023, these 7 stocks went up 76%, while the rest of the market barely moved. It was as if 7 players were carrying the whole team. But something shifted in 2026. This year, those 7 stocks are barely moving, and the other 493 companies in the S&P 500 are now picking up the slack. The team is finally playing together. That is actually a healthy sign. When gains spread across more companies, the market has a stronger foundation. It is less like a house of cards and more like a solid building. So, bubble or bull market? Honest answer: nobody knows for certain. But here is what history tells us with high confidence. Trying to time the market, waiting for the perfect moment to get in, almost never works. Of all the bull markets that made it to their 4th year, every single one ended that year positive. The average gain in year 4 was nearly 14%. That does not mean this one will. Past results never guarantee the future. But it means the odds are not against you. Now, what should you actually do? 3 things. Simple ones. First, keep investing regularly. Every month, a little goes in. You don't wait for the perfect price. You buy through the ups and the downs. This is called dollar cost averaging. It means you automatically buy more when prices are low. Second, don't put all your eggs in 7 baskets. Those magnificent 7 stocks have had an incredible run, but even great companies have rough years. Spread your money across more of the market. Third, keep some balance. Not all stocks, not all cash. A mix of stocks, bonds, and maybe some international investments gives you a cushion. Back to Marcus and Jake. Marcus never knew if the market would crash. He still doesn't. But he kept investing anyway, because he wasn't trying to beat the market. He was just trying to stay in it. Jake finally decided to start investing last month. He didn't wait for the perfect moment anymore. He just started. That moment, right there, is the most important financial decision either of them ever made. Not when to invest, just that they did. The stock market will go up. It will go down. It will scare you. But the biggest risk is not a crash. The biggest risk is sitting on the sidelines while the world moves forward without you. If this video helped you think about your money differently, consider subscribing. This channel exists to make finance simple, the way it should have always been explained.